All right, the federal government is finally moving ahead with its public-private partnership to buy up troubled bank assets, but one early supporter is not part of the effort. Bloomberg's Peter Cook is in Washington with the latest on the PPIP. Peter?
Well, Matt, the Treasury Department formally selected the 9 asset managers late Wednesday to partner with the government in the public-private investment program, better known as PPIP. The list includes BlackRock, Invesco, other familiar names from the asset management business. They'll now have access to federal funds to buy up distressed assets from financial institutions and share in any upside with taxpayers. But there is one name not on the list that comes as somewhat of a surprise. PIMCO, the world's biggest bond manager and an early backer of the PPIP program, says it withdrew its application in June because of uncertainties about the plan's design. A PIMCO spokesman declined to comment on specific reasons for the withdrawal, but said the firm will continue to participate in other federal financial programs. The Treasury acknowledges the program is a more modest version of the plan originally unveiled back in March. Instead of $100 billion in TARP money towards purchases of commercial and residential mortgage-backed securities, Treasury is providing $30 billion initially. Some investors say given the way it's been scaled back, it's not a surprise PIMCO dropped out.
The thing is barely going to produce, 20, 30, 50 billion in business, and I just don't think it's worth them to get involved. Quite frankly, I believe that a lot of the people who did registered with a little nudge from Treasury, said, hey, we need your help.
The fund managers each must contribute a minimum of $20 million of their own capital and also raise at least $500 million from private investors within 12 weeks. The first closing on a PPIP fund is likely in August, according to the Treasury Department. And, Matt, the Treasury says the program could expand depending on the level of interest.
All right, Peter, thanks very much. Now, joining us is one of the 9 fund managers in the PPIP selected to buy up troubled bank assets. Bruce Richards is CEO and president of Marathon Asset Management, which has over $9 billion in assets under management. Bruce, welcome to the show. Thank you for joining us. Let me start off just by asking you why one of the bigger players backed out of this. I mean, is it no longer as much of a win-win-win proposition as maybe Bill Gross thought it was at first?
We think it's a fantastic program. The U.S. government, U.S. Treasury, spent an inordinate amount of time over several months putting out an RFP to the money management industry, and they had 104 applicants. PIMCO was one of the managers. Marathon, BlackRock, others were the managers. From that, they selected 18 to go down to Treasury to visit with Treasury 2 months later after the application process went in. And from those 18, selected 9. So we think there were 9 very credible managers that were chosen. As to why PIMCO opted out or elected not to be in consideration when the final analysis was made, you'd have to ask Bill Gross and PIMCO. But I would say that on the front page of the New York Times, just a couple weeks ago, in the Sunday section, Bill Gross was talking about this being exactly that, Matt, a win-win situation, where it's a win for the government, a win for investors to be able to buy these distressed assets at these dollar prices. And so we agree with Bill Gross. It is a win-win situation.
He actually came on our show and said at the time that he expected to easily make double-digit returns from this program. Is that the kind of returns that you expect as well?
Yes.
Can you elaborate? I mean, double-digit obviously is a big number.
Double-digit is a big number. And when you look at other assets that you can buy from the U.S. government right now, or have government financing right now, one is TALF. And the spreads have come down considerably on TALF, where the latest auto securitization deal done by Bank of America, $3.5 billion, was offered AAA securities at a 2.6% yield. And you can take that leverage and go to the Federal Reserve and get 14 times leverage for an 8% yield. And so these assets, unleveraged, we believe, is in the teens, and certainly with the government financing that the government's providing the PPIP managers, the 9 of us with, will get you well into the double digits.
Let's talk about the size of the program. The government's going to chip in $30 to $40 billion here. Originally, they were going to go in with $75 to $100 billion to start, I believe. Why the reduced size?
Well, Matt, you have to remember that PPIP originally is for legacy loans, which this is not. This is for legacy securities.
Right.
And so the eligible assets are the RMBS and CMBS AAA or formerly rated AAA securities. That's the eligible asset pool. And so that's half the program. They may come up with at a later time legacy loans, and I think they're leaving some room to be able to do so. So in this case, the U.S. government is contributing $10 billion of equity along with the $10 billion that we raised in the marketplace collectively. And on top of that, $20 billion is also providing $20 billion of leveraged finance or debt, long-term debt, up to 10 years debt. So allowing us collectively, the 9 managers, to have $40 billion in buying power. And we think $40 billion is significant and represents a fairly substantial amount of the free float in the marketplace. Will certainly have an impact on the market.
Let me ask how easy you think it's going to be to go out and raise the money. You have to raise a minimum of $500 million with your partner, I believe, Blaylock, Robert Vann. Do you expect to get this done very quickly?
We think there will be strong demand for this program. Remember, this is the first time ever that the U.S. government has hired asset managers to manage money on their behalf. So they hire Boeing to build planes. They hire Lockheed to build missiles. They've never hired asset managers and paid asset managers a fee to manage their money. So this is an opportunity for the investment community, for investors, to invest alongside the U.S. government to buy up what we think are extremely cheap assets, and not only that, for the government to provide financing which enhances the returns. So we think it will be met with sufficient demand and probably be oversubscribed.
And how high oversubscribed? I mean, obviously there's a ceiling on how much you can raise. What do you expect the outcome to be?
There's a finite amount of capital being raised here. You're talking about $10 billion being raised among 9 managers. So if you do the math, it's $1,111,111,111. So call it $1.1 billion being raised by each manager. There may be a manager that could raise $5 billion. Well, they can only offer $1.1 billion. So we believe that all the managers are quality asset managers, are highly qualified. Treasury did a great job in selecting the managers, and we believe that we'll be able to raise the capital without too much effort.
Let me finally ask you about price discovery, because a lot of people are pointing to this as the most difficult issue of the program. Do you think you're going to be able to overcome this, or will it be a tough ride?
Yeah. Remember, these are securities, not the loans, so the securities trade all the time. And we're talking about AAA rated, or at least at time of issuance, by Moody's, S&P, Fitch, formerly or originally AAA rated securities on the residential and commercial side. And hundreds, if not billions, of these securities trade in the marketplace every day. So there is transparency in the equity market, there is transparency in the debt market, in the commodities market, and there is transparency in this marketplace. And so it will undoubtedly add to liquidity when you have a technical bid to tune of $40 billion coming into the marketplace, which you're transacting with. But certainly these markets trade. The securities are out there. They're not only available to buy out of the banks, but to buy from any institution that's a willing seller. And given their securities, they are marked to market by the banks, and so we think the banks will take advantage of a bid that's developing in the marketplace and sell what were formerly AAA rated securities that are now lower rated securities, and use that as an opportunity to sell potentially.
All right, Bruce, thanks so much for joining us. Bruce Richards there, CEO of Marathon Asset Management.